All
right, we're
Hello,
live.
everyone. We're live. I got Chris and Vitaly here. Potentially, Amit might be joining us later, but I think he's got some obligations. Who knows? Some VC funding or something for Idea, or maybe he's just using the washroom again. Who knows?
I just want to point out that me and Chris are not trusted enough to oversee this podcast. We need to bring
you
in.
can
I know
oversee.
it was so weird. I'm just like,
What a weird
Tanner's
thing.
gonna be hosting. I was like,
I'm
okay,
like,
I guess.
so we are just chopped liver, and Tanner,
I
continue.
I absolutely did not sign up for this. I get it. This is how it works. Okay. Amit sends me a text. He goes, "You're on tonight. You're hosting. It's you, V, and Chris." And I was like, okay, cool. That's the end of that. You follow the leader. So
I mean, we didn't even get asked. That's all I'm saying. Just ask.
You know, Vitaly, we need to unionize, man.
Yeah, I
you
mean,
know
I think we're losing power here. I don't know what's going on.
We're losing a lot of power here. It's time to unionize and take back some of this control, brother.
So how you guys all doing? Chris, what are you buying?
What do you mean, like stock-wise?
Yeah, what are you doing?
Not much right now. I'm doing a lot of due diligence on a few companies right now, primarily Google, PayPal, Amazon. I know they're the ones that are
we're doing the same. We're doing the same due
Yeah.
diligence then.
Yeah, I guess. I'm also doing more research on some of the regional banks, like some other ones that are out there that are doing more like servicing. I'm also doing some research on legislation that's favoring regional banks over the mega banks, because like the mega banks traditionally, like if you go back to 2008, the government doesn't want to get into a scenario where you have too big to fail, where there's like a Canadian situation. So Tanner, you know how like you guys only have like 6 banks that control 90% of your banking needs. And that's really bad for the consumer, because that means that the quality can drop significantly. In the US, we've got hundreds, if not thousands, of banks. And so the federal government is trying to create legislation to protect the more regional banks, depending on depending on how much assets that they have. So, like I said, a lot of my research is just due diligence on that, because there could be some potential like beneficiaries on that side. So that, and then there's one other thing. It's multifamily real estate. I think there's a lot of construction, and I don't know. There's part of it feels like there's a bubble. Part of it feels like there's normalization, but it just depends.
It's funny whenever you said the Canadian banks, they don't really need to innovate, because there's only like 4 large banks in Canada practically, and then but yeah, TD Bank here in Canada still charge $10 a buy and $10 a sell here. But in America, for TD Ameritrade, it's free commission. So they didn't even need to change the Canadian one, because there's no Robinhoods, there's no Weebles, M1 Finance. They're all south. So we really don't have many options.
How's that possible? That they can still do that?
Legislation. They have a lot of onerous regulations if you want to be part of like a certain class of bank or a certain class of broker. So in order to get through those hurdles, you have to play the game. And so a lot of these guys, they have undue power in their government via influence, and so they can create artificial barriers to entry. So this way it keeps them in charge. I mean, that's what most big corporations do, right? When you look at legislation, you think that legislation is coming from like politicians, but most of the time it's usually written by industry incumbents to prevent more competition coming in. Like, and it's a sad state of affairs.
And the minimum requirement for capital ratios here for the large banks in Canada is really high. So for some of the smaller banks, it's really hard to stay profitable whenever you can't leverage quite high, like what happens in America. But the large banks, because they have all these other fee structures and everything like this, that they don't really have any competition from fintechs. There are a couple small players here and there, like Neo Financial or Wealth Simple or these sorts of things, Quest Trade, but there are few and far between comparatively to the options that you guys have. It's crazy. Yeah, go ahead.
Well, I was going to actually talk about Google, because you mentioned it, and PayPal we can discuss a little bit too, because I'm looking at the same thing, and Amazon. So today I did another synthetic long on Amazon because it's sort of ridiculous. You could pay 4% a year, roughly, so 8% I think total for to hold a call and sell a put. Basically, I'm paying 8% for 2 years to see what Amazon does. And I want to get to Google for a second, but do you want to see the chart of Amazon? It's kind of interesting.
So yeah, we won't be able to share it.
Oh, we have no ability to share. Slides?
We have no ability to share. It's a myth.
Hold on, let me draw this chart.
We're gonna have a discussion after this.
This is ridiculous.
Pod.
Hold up a mirror.
We can go back to the banks, and PayPal is sort of, they're not a bank, but we'll talk about PayPal too. But anyway, if you look at the chart, and I'll describe it. But remember that channel, Chris, we covered that it's in this massive bull market for like 20 years.
Mm-hmm. Yeah.
And if you just were paying attention to this channel, you could have probably made a fortune. We are back at the bottom of this channel. It's insane. It's insane that we're actually back in it. And maybe I'll post it. I think I posted on our Discord. So if you want to go check out Freelancer Finance Discord, I don't even think I'm allowed to post a link, by the way, in the chat. So I can't even do that. But if you check out the actual Discord, we'll find it somewhere. You'll see this chart, and it's crazy. We're at the bottom of it. So the way it's projected out is that we are somewhere between 170 and 350 if we stay in the channel. This is a big if, but it's been in this channel for like 20 years, no joke. And we're back in it. So between 170 and 350 approximately in 2025. So I made a synthetic long today.
That's a good. I mean, one of the things that I like is management with Jassie's taking a hard stance on unnecessary expenses. Like right now, they're really digging deep into a lot of their investments on content for for their Amazon Prime Video side, because it's one thing to spend money on content that ends up providing an avenue for more revenue going forward via Prime memberships. But they're starting to realize that, hey, we're taking billions upon billions of dollars, putting them into these shows that aren't materializing into any additional value to like the viewers, right? So like this is one of those areas that's like a soft target that you can just go into, take out, and just say, you know what, we're not going to spend money on content we don't need. If anything, we'll spend more money on licensing successful things rather than trying to do our own things via Amazon Studios, and use that savings to once again boost our cash flow and buy back shares while they're cheap. I think this is a very similar moment, like a Meta moment, where we had this last year, where you had like Meta cost rationalizing by making strategic layoffs and cuts in divisions that weren't profitable, and then using that to boost cash flow so that this way they could buy back shares. So I think Amazon's in the same boat. The other thing is, if you know anything about Amazon and how their compensation structure works, primarily their total compensation has this built-in assumption on a per year basis of 15% growth. Okay, so that when they issue you shares, they're like, look, we are assuming a 15% year over year growth in shares. So what they'll do is, Amazon is notorious for this, their compensation for their like just workers, the dollar amount that you get is not very high, but the shares that you get in Amazon is relatively high. So what ends up happening is that additional growth rate ends up boosting your salary to the point where now you can hire competitively. Because Amazon's share price has pretty much been down and that 15% year over year hasn't materialized, a lot of employees are not, I don't want to say hurt by it, but they're not exactly happy about it, right? So on one hand, Amazon has to figure out, well, how do we boost up our share price so that this way our total compensation actually makes sense and we can retain talent. So on one hand, they're strategically laying off divisions that don't necessarily make too much money. On the other hand, they're going to be using that cash flow now to reinvest it back into shares so that they can boost the share price so that their total compensation can get more rationalized again. Because I mean, that's what happens. If you join Amazon, it's pretty much a thing that they tell you, like there's a 15% year over year expectation of growth in the share price.
So I never looked at the share dilution in terms of Amazon. That sounds really bad, actually, that they're just planning to keep diluting this much every single year.
Well, the thing is, remember, it depends on what they're utilizing their cash flows, right? Like, and it's not 15% like of the total company. It's just compensation wise per employee. They have
Oh, their
built-in
salary, you're saying,
assumptions. Their
basically.
salaries. Their salaries have built-in assumptions of that. Yeah, go ahead, Tanner.
Sorry, I wanted to understand that. So they're assuming a 15% growth in the stock as part of forecasting for their retirement accounts or whatever, which would look pretty
Not just
lofty. So they
retirement.
don't have to.
Sorry, go ahead.
No, I just mean as a stock-based compensation for their employees, but hopefully, vesting it to keep talent for the long term. Maybe it shouldn't be called a retirement account, but that's, the way I think about it. But that seems extremely aggressive. And then because if the stock hasn't been performing as of late to employees' expectations, does that also mean that you've been seeing pushback in terms of higher stock-based compensation than what they've been previously seeing? Have they spoke about that?
They haven't necessarily spoke about it much, because when you get hired, your compensation and everything else, you have to weigh your options against like other companies that are out there, right? Like, which one do you want to work for? Well, you can, but when you go into like big tech, it's a big discrepancy on how it is. Some companies, they favor more upfront cash. Some of them are more equity based. Like, we want to hire talent, we want to retain talent. Equity is the way to retain talent for their business model. It just depends.
Well, because the thing is, the options vest over a number of years. That's why it's important to keep doing this. I just didn't know it was 15%. That's what I was talking about. That at some point, it's 20 years old, that company. It has to lower that compensation in terms of shares at some point. Do you have an idea when this is happening? Did they talk about this? Because I've never heard them mention anything about that.
So let me find the due diligence. I'll send it to you later, because I don't have it pulled up right in front of me. But yeah, like I said, Amazon's compensation is heavily based in stock rather than being based in actual like just share
salary, right? In salary.
Yeah. Salary.
Okay.
Well, here it is. I actually found it. Sorry. Here we go.
Someone in the chat says they got
we can't show it.
Yeah. However, Chris, you do have a monitor. So I think Ray said it on screen. You do have a monitor that's visible on screen. You could just put it up there.
I'd have to go no, it's fine.
Sure.
We'll figure this out another time. Well,
so
who's
someone
the host?
said that they
There's
got
no host?
No, Amit's the host.
So he's on here, started the lot. Man, next time just let us do the. All right, forget it. We'll talk about this later. We'll make sure. Yeah.
Someone in the chat said that they got an offer from Amazon, and they said they can help us with some of the understanding the packages that they offer here. And he said the restricted stock units is vested over a 4-year period. When they give you the initial grant, they assume the stock doubles in that period. That's that's aggressive.
Yeah. Well, I have the damn slide right in front of me that shows exactly what it is, but it's hard to show it here. But basically, it's just the growth assumption for Amazon right now. If we're looking at it, fucking hey, man. Right now, based on
I think we should just change the podcast and just bitch about Amit.
based on the growth assumptions right now, the stock price, based on what was promised by Amazon, should be hovering close to $166 to $214, like somewhere in that range right now. Of course, you're gonna have your fluctuations, whatnot, but basically that's what it is. By 2030, the stock price, according to their compensation on a expected 15% appreciation, is supposed to be like $571 a share.
Amit's in the chat, commenting on everyone's thing, but not sharing your screen. Okay. Did we want to maybe pivot onto some PayPal or something?
Sure.
Tell us what you guys are reading about right now.
Yeah, I'll start it off.
Yeah, go ahead.
Yeah, I was going to say PayPal's in a place where their valuation has gone down significantly. Most of it probably because of the competition that's starting to just bubble up. There's so many fintechs coming up. It's good for the consumer, because it means from a consumer standpoint, you're going to get the best product. Competition brings out the best in value for the consumer, because they're always going to be trying to attract you, whether it's through higher APY, better services, more breadth of services. all the stuff that comes with it. Now, PayPal is still the incumbent when it comes to transacting online for a lot of things. Like these guys are the original fintech. This, so they have this incumbency built in. So if you look at any websites that you go to, I would say about 7 out of 10 websites right now.
Anit has joined the chat.
7 out of 10 websites from what I've seen allow you to do payments via. Hey, Rango, what's going on? Via PayPal. So yeah, what's going on, Rango?
Pretty good. I mean, Amit asked me to join, so I was like, okay, yeah. I'm doing nothing. But then I have to leave in a bit.
Okay.
Yeah, it's just about Amazon. So they have a
step 1: rotate the.
No, it's okay. It doesn't matter.
There you go. That's better.
Yeah. So on Amazon, right? So it's the compensation philosophy is nobody gets rich too soon and leave Amazon.
That's not bad.
So basically that's where it stands. So whenever they give you an offer, it's like the first 2 they have like a weighted vesting. So it's like if they give you $500,000, for example, in the initial grant, only 5% of the stock vests the first year, and then the 10% vest. To 15% vest the second year, and then 40 and 40. The reason they do that is RSUs, whenever it vests, you have to pay taxes on it. So they make sure that it doesn't, and they compensate the remaining with cash in the first 2 years, right? So, and they make sure that the unvested RSUs is in the backlog so that can double your salary, total compensation. Because as soon as it vests, if you have to pay, your leverage of what stock you're holding, it just goes away. So they just like compensate. That's an interesting way they compensate. So it's, for example, Tesla they give you a bunch of options. So if it goes to the moon, then you can retire, for example.
It doesn't vest, but don't you have to wait 3-4 years for
4 years? But that's the thing, like it's options, like it's not RSUs.
Yeah. The difference is with RSUs are like cash, whereas options, if you don't hit your targets, you don't get anything, right, Rango?
So our options is like a strike. They have a strike price and like the number of options, right? So if your stock doesn't do anything, it's basically zero. But they give you a choice. Like you can take RSUs, you can take cash, or you can take options. But if you take options, it's 3x the leverage.
Yeah.
Yeah. So it's like if you want to do it, you get 3x. So
I assume you took the options.
Yeah. Most of it I took my options.
You look like a gambler to me.
It's like a 10-year vesting, 10-year expiry, and you can choose the weightage. Like you can do 50%, 30%, 20%. You can choose your own weightage. So
interesting.
Right.
Yeah. On the Amazon side, it's more based on RSUs, right?
It's like they have like a bonus and RSUs combined. Like in each first 2 years, it's cash heavy, and the last 2 years is stock heavy.
It must be pretty sucky for most Amazon employees right now, especially on what we're talking about right now is the white collar office workers. Yeah. We're not talking about the warehouse employees. Okay. Just so that everyone understands, like if you're in the warehouse, you're not getting like stock compensation like that. You're getting your 15 minimum wage plus maybe like now a little bit higher. But right now we're talking about white collar, tech heavy focus personnel that are going to be working on the office side of things. So their compensation can really be up there, but a lot of it is based on the performance of the company. So right now, Amazon's employees are probably working twice as hard, technically speaking, because they want to make sure that the company does well, so they do well.
And here's another interesting fact. So they have.
They kicked him off.
There you are.
There you go.
Oh, I don't know. So they have adjusted down compensation this year in the refreshers because they are expecting even higher growth in the next few years.
Yep.
That's perfect. They expect it to triple actually in the next few years. Like that's what I heard.
This is what I was trying to show.
Vitaly wanted to hear. That's what Vitaly wanted to hear.
I'm saying, look. I know Chris is actually talking about fundamentals. We're talking about the fact that what Jassy is doing internally. Like I understand all that, and I do follow that because the fundamentals of Amazon are strong. Okay, I don't care what anybody says.
It's very strong.
Amazon it's extremely strong. In fact, today I got an offer for Walmart, $50 to do their Walmart Plus, whatever it's called, and I have to think about it.
Yeah.
Amazon Prime. Who thinks about Amazon Prime? You just get it.
Yeah.
So they have such a strong moat. It's insane. So my point is that's why, okay, the fundamentals are covered for me. Like we can talk about Jassy. We could talk what they're doing with stock-based compensation, which sucks, but they're doing it because they got to incentivize people. But when I look at the chart, they've been in a 20-year bull run. No joke. 20 years straight up in a certain channel. And I wish I could show it, but it's on our Discord. And we're at the bottom. We're at the bottom of this channel, which is insane because when me and Chris were talking about the stock and buying, I bought call options. I think you bought call options too, right, Chris? It was underneath that chart. So it was a possibility we were breaking down and not going to return into this particular trend. We're back in the trend. That's all I'm saying. People should really pay attention that these companies, these massive, even Tesla, by the way, they're in these massive bull trends that sort of follow a path. Okay. Enphase does the same thing. They all follow this path. And it just shouldn't be ignored because we're at the bottom of it. That's all I'm saying.
I've been following Enphase a lot more lately, by the way. I want to have a conversation with you potentially after.
Okay, sure.
Hey, Tanner, I follow your content. It's pretty cool. I am a shareholder of SoFi too. Yeah.
Yeah.
Oh, don't gas up, Tanner. No, and Tanner, you're scum.
I love being gassed up. I love it.
You're scum, Tanner. See, this is what happens.
Hey, you're in the minority here, Chris. You're the only person that doesn't hold SoFi now. It's 75-25.
Wait. You have no SoFi?
I have no SoFi right now. Nope.
But you told
Actually, you told me it's going to 100 billion. I think
it's going to
$100,000 into SoFi.
It's going to go.
He's going to hold that for 10 years.
He said 10 years, 100 billion. I remember this.
Did he actually say that?
Yes,
I have better opportunities right now that I've parked my money.
Guys, I hope you're paying attention. This is why you don't follow the finance junkies into anything, because the minute it goes up a little bit, this guy's out. He's just out. Boom.
No, it just traded too fast. So go ahead, Rango.
Yeah, a little bit, 100%.
For Chris, actually, I have a question for Chris. Which is the stock which you have held for the longest time in your investing career? And how long has it been?
It's probably just the S&P 500. Like
I mean, individual stock. Yeah.
You know what? I'd have to look.
Google.
I have I don't have Google that long. I'm trying to think what the longest would be.
It's around 3 days.
Is it a big tech?
No, it's just to be honest.
He held the S&P.
No. To be honest, like the longest I held a company was BlackBerry. Like BlackBerry, I held in
the wrong one to hold. Amazing.
No. I don't still have it. I'm just saying I held it for like 6 years. Like when John Chen first joined BlackBerry, I was a firm believer. I even had the first BlackBerry, like the Passport. I don't know if you guys know what that is. You remember? Yep. Tanner, you should know the BlackBerry Passport. It was like a square
I don't
screen,
remember the names.
Right? Yeah. So I actually had that for a long time, except, because of that, I've been scarred by it. So now I think I'd really have to look into my portfolio to see what it is. Like there's a couple of long-term pharmaceutical plays that I have that I've written down all the way to zero, but those are like speculative names that I just put on the side and I don't think.
Well, you probably had very little invested in them, so
I had very little invested.
So, like if I throw 1,000 into some stock, I mean, if it goes away, big deal. That's like it doesn't mean anything.
Exactly.
So
this might be. Oh, sorry, Rango. I just wanted to say this really quick. This BlackBerry Passport might be the ugliest product I've ever seen. Everyone needs to Google this. Like, I cannot believe you saw this and thought, "Oh, I have conviction around this product. I'm going to hold this for 6 years."
This was not. It was really good. Like, I was a firm believer that
it was the iPhone
the keyboard wouldn't go away. It was the keyboard. Keyboard would be good. Like the screen was a square. It fits into your pocket. Like it was. Like I said, this is when I was a much more novice investor back.
No, but Chris, I mean, this is a real problem, and I'm not trying to shit on you because look, if you see an opportunity to make money, I understand, but then why do you say things like this is a 10-year hold, this is going to 100 billion? Why do you say that even? Like, don't even say that stuff. Like, say, you should be like, this shit pumps 2x. I'm out, dude.
Yeah, that is a good point. Maybe I should be a little bit more like clear with that. That hey, you know what? There is a portion. There is a.
I invest a lot of money because of your SoFi bullishness, and I'm still in it.
Like I said, overall long term, SoFi will do very well. I just feel like there are so many targets. Like there's so many opportunities right now.
Okay, what's
in the
better? Well,
market.
what was better than
Huh?
that you went to? I'm
Amazon.
curious.
Amazon is Google right now. Google's
Well,
better. I have spreads
okay,
on Google
so-
and Amazon. I'm adding to look. These are the things that
Okay.
I'm adding
I
significantly.
can't argue with that. I'm buying that too. I
Okay.
can't even argue with
So,
that.
so right now I'm freeing up some cash because, like I said, I want to take care. I want to probably take a position in PayPal for a recovery play. Right. I think there's so many companies right now that are undervalued that could be recovering rather quickly. I guess for like the last year, my longest hold has been Meta. Like Meta has been since November. I haven't touched it at all. I don't plan on touching it.
Have it.
I sold
right?
I sold the call options, but I kept the spreads that I had on Meta because they literally shot up. But I still have the stock, right? I'm cool with the stock.
I sold my call options too, and yes, I'm
yeah.
keeping most of the stock.
So
Yeah.
So that kind of settles the argument, right? Because Vitali always says, "Hey, Chris doesn't hold anything. He doesn't have the temperament when it drops down 50%." That's the question I had. But everybody's investing style is different, right? So
but the thing is, that's fine. I just don't want you to say you're the 10-year guy waiting for this to happen when you're not
I don't
that
think
guy.
I don't think I'm the 10-year guy.
Yeah,
I just think,
that's it. That's it.
Yeah.
As long as you admit that and people know, I think it's totally fair for you to trade in and out, because if you just say, look, I'm looking for opportunities, I'm trading all of this stuff.
Yeah.
That's it. That's cool. That's fine.
The one company that I do want to try to hold super long term is going to be it's the truth. It's SLG, because
his fingers on the button.
The reason
damn, it's gone.
The reason why is because I've got it at such a good price
SLG?
that now the dividend
you sold
income,
that out and went to somewhere else, and
I bought it back. I sold puts on it, so I bought it back. Okay. But the reason why is because the monthly dividends are so fucking good that it's going to allow me to diversify into other things. Like, my biggest problem right now is cash flow.
Are you still in Truist? Because
that's exactly
I bought some spreads, motherfucker.
100 dude, I have
because his dividends are so good.
I have an obscene amount of Truist. Okay. So I think right now my biggest thing is I'm trying to generate cash because I'm seeing so many opportunities. Like, opportunities like this don't come often.
Well, I do want to point out Amazon, Google, and PayPal too. I would put that in there, but more Amazon, Google, just because it's obvious.
And Face.
Yeah.
Oh, no, but I mean, just like obvious. I mean, those two are bound to go up. Like, if you were to have like the safest 2X's in your whole life, no joke, I really believe Amazon and Google are like just safe bets. Like, I don't worry about it. You know, like the certain stocks you can worry about at night.
I actually agree with Tanner's Google take a lot more than your Google take. Yeah.
That's fine, but you could still see if something's undervalued and something is going to double.
I like Rango a lot.
Given enough time, Google will double. The point is,
given 20 years,
5 years. Given enough time,
I think this is where you're wrong. I think as soon as Google runs, and it's probably going to be at the end of the year with Amazon, or maybe into 2024, I bet you we get closer to 200 than not, which is close enough to a double.
That's possible. I mean, in the short term, it's hard. You can't, like, it can go to 200 and come back. Like, depends. Like, it always
but Chris gets his 200, he's out, so he's going to make his money and he's out.
I have a question, because I don't want to dive too deep into the Google thing. I find it's so exhausted every time I come on.
Well, I'm gonna say one other thing about Google after you go ahead.
Sure. and then we'll pivot on to what AJ said. AJ says PayPal is the definition of a value trap stock.
We should talk about that. Yeah.
Go ahead and finish up your Google thing, and then we'll jump into.
So Google, one of the bull cases that I didn't really realize as much, and I just started. There's some YouTubers who are actually promoting this. I forgot what their name is, but they're the ones who inform me that you can now like sell products easier through Google, and a lot of creators are starting to sell products through YouTube. So YouTube has
through Shopify.
Through Shopify too, right? Which is, I know that integration happened a while ago, but I think they're pushing it much harder right now. So I never
it's in Shorts now as well. It's all over the place.
So I never thought of YouTube as a place where I would go actually buy merchandise, but it seems like it's totally obvious that this is exactly what's going to happen. And I think this is one of the reasons, if I'm to give a bull case, that Google will go up. Okay, at least I got my double out of it. Because if you looked at Amazon 5 years ago, you're like, well, how are they going to make money? They're not an ad company. And then they start this whole new business, and they could generate 40 billion a quarter in ads, right? Is that right, Chris? Is it 40 billion a quarter? Something crazy.
40 billion
for what?
For ads. What was the ad?
For which one?
A year.
For what company?
10 billion a quarter.
Amazon.
Amazon.
Oh yeah. Their ad business is growing like crazy.
But I'm saying that was something you probably wouldn't have expected maybe 5 years ago, exactly the same way. I think YouTube is doing something similar, which is Google, of course. You're going to have just us buying merchandise, just like you do on Instagram right now, and you're clicking on some ad, but now the creators are behind it. Now you want to support some of these people. So I think it's actually going to be a massive business, and that helps YouTube, which helps Google. So I think that's a good bull case, at least for me. To think that.
I mean, the problem with Google is their culture is just that, like, there have been a lot of massive businesses they never execute on. It's just that's the only thing. There have been so many obvious businesses.
Yeah, this is not a separate business. This is YouTube. They're just scaling it to a whole different, basically using the ad network they have in between. Now they're selling products as well on top of it.
I mean, they could have done that a long time back, right?
Yeah, but I don't think this is that difficult for them as they scale this.
I mean, it's not, but they could have done that a long time back, right? That's my question.
Yeah, I don't know the reason. I don't know the reason they didn't push it, but maybe it's the Shopify deal that maybe as Shopify grows, it makes it easier to do this. I don't know. I don't know what the reasons are for that. That's a good question.
Yeah. But one bullish data point on Google is that this stat I think people are missing. 50% of the searches is actually like you don't find an answer to. The chat GPT and the generative AI stuff is actually going after the other 50%. So you're technically like increasing the market share, but you have to do it profitably, which is the hard part because the inference cost is so high. Yep. But that's one data point which is technically bullish, but I don't know if Google can execute on that. I just don't have the trust in the upper management.
So let me ask you a question, because I did watch an interview with George Hotz, and he's like fucking fantastic programmer. He talked about
he's the best.
How Google's TPUs are actually the only real competition for NVIDIA's in terms of all of this LLM stuff. So my question to you is, since you deal with some of this, they make the TPUs that are actually good, meaning that they can scale this a lot easier and cheaper than a lot of other companies that we keep talking about.
But the problem is not that. Even with the TPUs, the inference cost with respect to just the power taken, that's why they designed the TPUs in the first place, because they're already the search's inference cost was so high. They designed the TPUs to get that down. The problem is structurally this generative AI is like doing like a million searches. It's like put 2 words in the next word, again put the second words, and you can do a bunch of stuff in the caching layer. You can do a bunch of stuff in like the software side and system side. But like right now, the cost is like 1,000,000 times higher. Like not just like 1,000 times. It's like 1,000,000 times.
But you're talking about today. What is it in 3 years, 4 years?
What? Maybe like 100 times higher. But that's still a lot. That's what I'm trying to tell you. And you have to do it, and you have to keep that margin, which is the hard part. You have to keep that search margin. And that's why Google.com doesn't automatically go into like generative mode. You have to go to Bard separately to use that, because not many people go to Bard and use it, and that's why the cost is generally lower.
So let me lead off with that. Facebook's LLM, which has way less parameters, is apparently just killing it open source wise right now.
Yeah, Llama is good, yes, but the problem is.
But I'm saying as the parameters drop, including for Google, if they can figure this out, then the scaling happens faster.
Yes, but Llama, but like that's not like a language model which can be like used to like the world language model. Llama is a very small language model which can be used to train. It's like a foundational model which you can train like very small specific language model for. You cannot just like do travel, like YouTube transcription, like 100 things you train on the foundation model.
Right, but
like
you can pick 100 things you do it for. Maybe it won't be used for everything. Maybe the big one is Bard, but what I'm saying is Google can put all these smaller ones, these cheaper ones, all over the place.
They do already do that. That's what I'm trying to tell you. They do already do that. It's Google's AI team is awesome. Like it's like one of the best in the world. It's just the strategic and the structural issues in the organization is the problem. They have like still a lot of middle management. Even after all the cost cuts, they're still really bloated. It's still a problem. Everybody go in DeepMind, just go on vacation. Like OpenAI is just grinding. Like it's just a cultural thing. It's unless there's somebody founder comes in and like completely changes the culture over there, it's not going to work out. I mean, it's like a vacation over there.
I like that you're saying it's not going to work out for Google. I like that you're saying
a deep mind. Deep mind,
yeah.
Interesting.
All right. I mean,
okay, guys, I gotta go. All right, I have to go.
I think that was useful. So we can transition and finish up maybe with PayPal, because people want to hear about that. Tanner, what do you think? Is this a value
Just
trap?
really, I just wanted to say thanks to Rango. I mean, I've been saying this for a while, but no one wanted it from me. But I appreciate an expert coming on and saying exactly what I've been saying. That and he's right. I wanted to say, but I don't like cutting people off unless it's Chris. And then no, I'm just joking. But they were what's his name?
We lost you. I think. Can you repeat that? We lost you for a second, or I did. And this is what happens when you talk bad about Google. We don't hear you, Tanner. Something's wrong with your mic or your connection. I'm not sure. Something happened. I don't know. What is he doing? It's charades now. I don't know what he's doing. A box?
I don't know.
You gotta fix your sound, dude. I don't know.
Leave and come back.
Leave, come back or something.
Well,
Chris, at least to you, I think someone mentioned PayPal is a value trap. Are we all getting suckered with this thing?
Like I said, I'd really have to do more research. I haven't done nearly the amount of due diligence in PayPal as much as I've done in some of the other ones, especially Amazon and Google. Google Cloud AI I think it's just killing it right now. They're all over the place. They're gonna do fairly well. I can't exactly name or figure out like a dollar amount, like where we might end up with Google, because there's just so many possibilities out there. And also like how much of their search business might get disrupted, all that stuff. But I know that you can't go wrong investing in Google. There's no way you're going to lose money in Google. You might be parking the money in some dead money for a while. That's the biggest tragedy with companies. And I think that's where I have had the worst experiences, where I've parked my money in losers for such a long time that I'm just like, damn, I missed out on opportunity cost, where I know that there were more sure things out there. I do want to just say one thing, because everyone keeps talking about it in the chat. I have a 6-figure portfolio in my retirement. Okay. Like I built up my 401k. I've been maximizing my 401k contributions since I first started working. Ton of money that's there. And then when I left my job, I converted it to a self-managed IRA. So I have a significant amount of money in my retirement that I use to trade and speculate on. So none of what I am doing affects my taxes as much. Like there are things that I'm doing outside of my non-taxable portfolio that I'm definitely gonna have to pay some short-term capital gains on. But when it comes to being in and out of companies, I do it in my retirement because I know I don't want to pay those short-term capital gains taxes. And also, majority of my dividend paying companies that I have are also in my tax advantage account. Now, the thing is, this is the one thing that most investors, they don't do, and they end up just forfeiting this amazing gift that the government gives you, which is Roth IRAs, even a traditional IRA, and a 401k. That if you have a Roth, if your employer lets you do a Roth 401k, bro, that's even better. So if you're not maximizing your contributions, even if like there's no match, I've been hearing this advice from people like, oh, don't put money in your retirement account unless just match it, just do the match and that's it. And I'm like, dude, tax advantages are so amazing, because in the future you're able to utilize that money to a good extent. So like right now, majority of my net worth is actually in my retirement account. Actually, no, I take that back. It's not. I've done actually fairly well in real estate as well. So yeah, it's like half and half at this point. But yeah.
I'm buying my first house right now.
Oh, nice. Congrats.
Which I heard that Chris said that might not be potential good idea, but
so let me just.
Well, what's your rate? What's your rate there in Canada?
I'm getting a private loan, so I'm getting a good deal.
Mom and dad stepped in. Got it.
No, I mean, whenever you work for a financial institution, it kind of helps. But
what are you buying?
It's a semi-detached house just outside of Toronto. So
quick, just a quick thing. If you're buying a place to live in, you don't plan on moving for the next 5, 10, 15 years, 20 years, whatever. Dude, buying a house is the smartest thing on the planet, okay? Because that money will eventually, like that you end up saving by not having to just pay other people's rent. I mean, other people's mortgages will end up benefiting you in the long run. Also, there's a sense of stability that you get from owning your own home that you don't have to worry about. Like that's the trap that so many people fall into. On the other hand, if you're trying to be an investor in this market, you are going to get screwed because you're buying at the top of the market at the highest interest rates. Okay, so that's the big difference. It depends on what you're trying to do with your home. If you're trying to become a multi-property landlord, right now is the worst time to be buying. If you're trying to just have a place that you can live in, I think that depending on your future life goals, buying a house, there is no wrong time.
But what about the advantages of getting in the home now, saving on the rent, and then refinancing it when the rates come down? So you save all that money, all those years. It's minimum $36,000, let's say, a year you save by owning.
I mean, it depends on your locality too, right? And where you are in life. If you're 20 years old, you don't have your education 100% set up, you don't have a stable career. I'm talking about a career, not a job. Like if you have just a job that you want to do and then move away, like, if you have your life figured out that you are going to be in a certain locality for an extended period of time, that's when you should be deciding to buy a house. And especially you should probably be married also with a person willing to share in that endeavor, because that's another thing that I see a lot of people make a mistake in. You buy a house and there's just you. If you lose your job, you don't have anything saved for emergencies, you could be screwed over very quickly. Whereas at least if you have a wife who's also generating some income, you guys could figure out, cut back where you have to and keep the house going for a prolonged period of time. So I just think that right now I'm not buying at the top of the market. No, that's good. No, that's good. I'm just saying that.
Are you married?
If you're
not married, but a long-term girlfriend.
So the both of you are buying it together?
Yeah.
Okay. Got it. Good.
Yeah. I'll give the opposite advice. So you guys should always be looking at real estate, no matter what market. And so Tanner, I think you're doing the right thing because like Carlos said, if it goes, let's say you live there and maybe you overpaid. And by the way, I bought at the peak of 2008, my house, and I overpaid. And then it went down to $100,000 in equity.
Yeah. Dollars. Yeah.
But I mean, I didn't sell. I didn't lose anything. And now it's over 2.5 times because I didn't sell and I just held it. So I think he has the wrong because he's trying to do a trade on a house. But
wait, no. I'm saying you bought it to live in. You bought it to live in.
Is like, what's the address? I'm sure.
But here's what I'm saying. He bought this property to live in.
Hold on.
Right?
That's
he bought it to live in. Yeah.
Step one, Tanner, you're doing the exact right thing. So even if your interest rates are high, they probably are. In a couple of years, they'll be lower. You'll refinance, and that's what everybody does. That's it. The problem solved. You'll be paying less money, and if you're smart, you bought a 2-family. Maybe you can rent out another unit. That's usually what I recommend, 2 families. But if not, okay, you have a single family. As far as in terms of buying real estate as an investor, I'm still looking. I don't care about the rates. The rates do not matter. I think this is what you keep forgetting. When you're buying a piece of property, the only thing that matters is the income that it generates. If it can generate enough income to cover the expenses of the house, that's it. That's the bottom line. And if it even at this point, the rates are too high and you are break even, let's say, and you bought a bad situation where you're break even. All right. And there's plenty of these deals, by the way. I look at them all day long. There's plenty of them. You're break even. You're not making money. So you're spending all of this time. You feel like you're losing. Okay. 3 years from now, you do refinance and you're no longer a loser. Also, rents are going up steadily, even if it's very little, 3%, 4% every year. So my point is there's a lot of benefit. Plus, I'm not even talking about all the benefits the tax benefits, expensing things like your car. Like there's all these other benefits that are ancillary to the actual property and the rental income. So if people look into all of that, I think you'll see at any point in history, it is always good to buy. Just have a solid plan as opposed to willy-nilly trying to speculate. I think what you're talking about, Chris, is speculators, because I had a lot of family members too. During the heyday, they were speculating on like properties that were super expensive in Brooklyn. They would buy them and they were not making any rental income at all. They were just expecting it to go up. Those people always have a problem because they're speculators. So as long as you're not doing that, I think it's the right time to buy real estate always.
Yeah, I think it's I don't know. I'm a big believer in the Canadian market right now. It seems like the population is seeing some of the highest growth rates that they've ever seen. Like seriously, look at it. It's crazy. And then even we just saw a recent regulation trying to get in more people in tech positions and the sort of digital nomad people. So there's new visas for all this. They're trying to triple the rates in which people come in that way. I don't know. I think that in this case, I've been here my whole life. It doesn't seem to go down near Toronto. Everyone says that there's going to be a down market in these cities. Like Vancouver's been a bull market since like 1980 something. It's like it has not had a down season. So I don't know.
As long as people are moving in. When I moved to LA pretty late in my life. I moved here when I was 37 years old, and I started doing the math. And again, talking about like financial responsibility, I really enjoyed living in an apartment. I really enjoyed the life of that, the convenience of it. And I was 37, and remember that was 2014. The next year, I said to myself, I have to buy a house. I don't even really know the areas, but I have to buy a house because I started doing the math, and I'm saying minimum $25,800 a year that I'm paying. So fine, if I can get 30 grand and do an FHA on that first house, I don't know if they have FHA in Canada. I said, I can start putting that money back into my pocket. That was the year that Vitaly called me and he was like, yo, we got this property. You want to go in on that? So 2015, that was the property that we went in on. Then after that, again, I was still enjoying living in that building, but I said, I have to get my own house. In 2017, I bought my house by myself. Now, obviously you're with somebody when you bought that, but I also think it's important to own that asset even before you go and find a relationship. I do think that there's an order that you have to do things, and it may be unpopular. I have a lot of friends out here that put me in touch with people, especially people that move, and I do some like sort of loose consultation for people, like say career consultations. And a lot of the guys that I talk to that are coming up, they ask me like, what do you got to do? And a lot of what they want to know about is how to move forward in their career. And my advice to them is always bank as much money as you can and get a property as soon as possible. Like I have a lot of friends, like I have a friend who knew somebody who was 26 years old, right? And he started doing this at a young age. He would go and start buying some properties. He eventually was able to live, he's 26 years old now, living in a property. He owns the whole building, right? And he lives in one of the apartments. He pays no mortgage. That's the freedom.
Well, I think you're trying to say
freedom.
The renters pay his mortgage.
Yeah. So he's got three. Yeah, he bought it. He ended up buying his way up to a 4-unit. He's 26 years old. He was a writer on a show called, what was that show? Superboy? It was a show like Superboy, a Superman show or something like that. And he's basically hacked his way. He's hacked his way to freedom. His life looks fundamentally different if you eliminate that one expense. And the thing is, he makes money sleeping, right? So he's like living in there. And if he wants to buy another house, he'll go buy another house, put someone else in that apartment, and that house will pay his new house. It's a life hack.
So there's one thing that's very that I hope people understand. I would say you have to look at 3 things to make a home really worth a good investment. Number one, the price at which you're getting can't be so freaking ridiculous that it ends up being a debt trap. Otherwise, your capital is going to be locked in for a long period of time, right? That's one thing. The other thing is you need to be in an area that's actually fundamentally growing, right? I know that Phi couple that we see, Vitaly, dude. It's all. I looked it up. It's all in Albany. They're leveraged up to the hilt. It's all in Albany.
They're buying shitty properties. Absolutely.
Yeah, they're buying tear down shitty properties in Albany, in New York, which the population is not exactly growing a lot, right? It works for them because they live a very frugal life, but their total cap rate is bullshit. Okay. And I don't think they're building enough of a reserve to the point where if they had a bad couple of years that they could actually survive, because what they're doing is just leveraging on top of leveraging on top of leveraging. So, but I'm not going to go into their financials. I don't really know too much about it. All I can say is a lot of investors
stab him a few times and
I'm just going to shut up for 2
a lot of
minutes.
people. The thing is, what they do is they make it. A lot of these people make this real estate thing sound so appealing, like it's the easiest thing in the world. Like, oh, we buy 2 properties every year using the cash flow we get from our original properties, and then the year after that we do 2 more. And it's like, yeah, but you're not accounting for a lot of other things that go into that. You're making it sound way too easy. And now there's a whole generation of people that think that they can get into this market and it's nothing but sunshine and rainbows. And I think I see that a lot in the Atlanta area where so many people were buying single family homes and then revamping them and then renting them out. And now they're stuck because their vacancy rates have started to climb up. So the rents that they were expecting, like the $2,000 to $3,000 rents, they're not materializing. The median income is not growing as fast enough to meet the cost. The cost of replacement for the properties have gone up. Property taxes have gone up. Like, I spoke to a few realtors in Florida. Right now, they're getting
real estate
killed.
Sound really bad.
No, I'm saying that
the other part of it, Chris, is I think it depends on the person. If you're coming in there and you basically want to be like a financial investor, I just want to buy the property and flip it, I think you're setting yourself up for doom. If you understand houses and you understand the systems in a house, that goes from everything from the framing, the walls, the different systems, whether it be electrical, plumbing. If you understand those things, first of all, I think you'll save yourself from buying a bad investment. That's just off the bat. Second of all, if something breaks, you are going to be able to save yourself the hourly rate of a bunch of these people and end up paying just cost. And so it becomes a lot easier to maintain those properties if you can do some of that work or almost all of that work yourself.
I want to add where I agree with Chris is that, okay, one, you should not completely overpay for a property because then it's not self-sufficient, as I talked about. It has to be almost self-sufficient. And that's easy to calculate. These things aren't difficult to calculate. Number two, if you don't learn, if you're not willing to, it's actually more willing to. If you're not willing to learn how to do simple things in your house, like Tanner, for you, you're not willing, you're going to be hiring contractors up the ass, and you're going to
and when they see you, they're going to charge you.
They're going to charge. You're going to quickly hate being a landowner. But if you are the kind of guy who's like, let me get my hands dirty, let me go watch a YouTube video, read a book, believe me, it's the best thing you can do for your whole.
It's actually a lot of fun.
And in all honesty, absolutely, I'll do that. But I got baby soft hands that are used to being on keyboards. But the truth is, that my brother owns a plumbing company. So if you guys start seeing plumbing ads all over my videos, you know I'm getting my bathroom's redone or something. So
right, and your shirt is all like
the ad changed. The ad changed for the first time in like 2 months. The ad it wasn't the Hyundai. It wasn't the Hyundai anymore.
Real estate, for the most part, is not as hands off as people make it out to be
it's
on
very
Twitter
hands-on.
and TikTok.
It's
Twitter and TikTok sometimes
I was just cleaning up shit today. No jokes. It's very hands-on.
Yeah. So real estate, the passive income stream.
Yeah, you're putting in effort.
It is not passive.
This. Yeah, it's definitely not passive. I mean, it can be passive if you're willing to sacrifice margins. Like, you could get a property management company to do everything for you, but then you're going to be paying out of there, and now you have to basically be intelligent enough to pick good properties at a bottom price and a good location that's growing. And then you can get into a position where you have so much equity that's built in and the rents have gone up so much that now you can hire a property manager and then just relax, So
but by the way, that does happen over the 10 years that you own your property. That's exactly what happens. So anyone short-term focused, Chris, you're right. You shouldn't do it. Anyone who's not willing to get their hands dirty. Yeah, you're right. Everybody else who's actually willing to do these things, no, you're wrong about that. They should buy a piece of property and they should spend the 10 years because that's how rich people get rich in America. It's by buying real estate and holding it for 30 years. That's how it happens.
Here's the thing. At the end of the day, you're paying someone's mortgage, Chris. It's just whether it's yours or not. You're paying somebody's mortgage.
I think we've been in such a secular bull market in housing, with the exception of the 2008 crash.
That's when I was buying.
But that's what one of the things I'm just going to say, if you look at it from investing in the S&P 500, like let's say in the year 2000, your dollar cost average, what would have been the better return environment? Would have been housing, like buying real estate, or would have been buying the S&P and just holding and just working a 9 to 5?
You know what? I'm going to answer. I'm going to answer you.
Different. They're different.
No, but it's actually the real estate. I'll tell you why. Okay,
because it's leveraged.
Exactly. So because it gives you like 900% leverage or something. It's something crazy. But you put down 5%, you get to own $1 million property or whatever, $500,000, wherever you are. So in Jersey City, when I bought my first house, I was actually buying real estate before, but I bought my house that I lived in, right? Peak of the market, I overpaid by $100,000. A year later, it was $100,000 less, right? But you're not thinking of all of the things that cascaded during the whole time. As rents were increasing in the area and people had to keep paying more money, I was fixed 30 years. My inflation was kept solid. I had to pay the same bills almost on a monthly basis for the next decade that I lived there. So you're not thinking about all of those cascading effects that happen when you actually own the property and you control your inflation rate as opposed to working in the system's inflation rate, if that makes any sense. So and by the way, the loan, let's say you take a 5%, 6%, 7% loan. Do you know the value of that loan 30 years from now? The 7% means nothing. The 5% means nothing. So I'm not saying we don't want to refinance, but there's all these cascading effects that help you actually control how much money you make. And that's why you have to buy a piece of property. If I had to pay rent and keep moving every 4 or 5 years into a new place, do you realize the cost that I'd be spending in the same house? It'd be $5,000 a month for an apartment. That's more than my mortgage in my house, which was around $3,000 when I bought it.
Mm-hmm.
So you're not thinking about all these other things. Yes, the S&P did.
Well, no. I'm just saying, if you're thinking about a primary residence, I encourage people to buy a home. The primary residence should always be that, because you know that you need a place to live, you need stability, and you shouldn't be sacrificing. What is that thing called? Rent for that. My thing is, if you're trying to do investing, if you're trying to become a real estate investor on the side, there are better opportunities out there if you are not a hands-on person. So like someone like Tanner, who doesn't want to get his hands dirty and he still wants to make a good return, he shouldn't become like aspire to be an Airbnb millionaire. You know what I mean? He should be looking for things like, hey, maybe stocks, bonds, things that actually generate tangible value can get me that, because I am not willing to put in the time. You, Vitaly, you've sent us videos on WhatsApp where you've actually gone to tenants' places. You've done the painting. You've done like contracting work yourself. So you are a different breed of landlord. I think what it is there is a new generation of landlord that's starting to come in that's thinking that it's just roses. It's just cash flow, cash flow, cash flow. And I think that's the thing that worries me. And the other thing that worries me right now is that, we've had ZERP for a really long time. That's been a big benefit to the housing industry, right? Where people have been buying using really cheap loans for a long period of time. That's number one. The other thing that's also been happening is there hasn't been a lot of building either. After the great financial crisis, building went down significantly. What we're seeing is a reversal in that, where now we're starting to see a ton of inventory just starting to come up. So I think that there's going to be turmoil in my research in multifamily housing for Class B and Class C housing in not so great locations that some people have really advertised themselves as, hey, this is a great investment. So there already been some CMBS defaults in Texas and Florida and the Panhandle, where basically you had all these real estate investors go in and thinking that they could just buy like a 20-unit, like a multifamily complex that was built in the 1970s, where everything is just fucking trashed, and think that they think that they can basically just price gouge the people that are living there, expect to raise rents 20%, right? And then end up like generating cash flow and passive income. Like I hate the fact that Amit's not here, because I want to share a couple of these videos, and it's literally like it's infuriating. It's infuriating to see that too. Like there's these guys that fucking do TikTok dances. Like, I just bought this 30-unit property and it's in the middle of fucking nowhere.
But once again, I covered this.
Yeah.
Those guys are speculators. There's a different sort of breed of an investor. And I know a lot of investors in Jersey City. You can call them speculators, but they have the money. And what they do is they sit on the properties because they know the area is appreciating. They actually just sit on it. They don't even fix it. They wait the 10 years, which is actually annoying for someone who, like me, who fixes the property, puts in good tenants, and makes the neighborhood better, thereby raising their property value. But this is what's happening. Okay, it's not hard to sell a property in a popular area. Like, no joke. I'm competing even now at 7% plus with people who come in all cash and pay $500,000 to $1 million easy, straight cash.
Definitely.
That's who I'm competing with right now. I can't imagine what's going to happen when the rates go down and these people,
that's honestly what I'm, even while we were searching for this house, it was just like 16 offers on a property. Half of them are all cash, no conditions. Like, the market in my area has not slowed an inch.
I'm going to go the opposite. I'm going to go the opposite route here. I'm going to say that as interest rates come down, we are going to see a cascade of inventory come on and basically drop a lot of prices. I think that that's what's going to happen. And I think that this is something that shocks people to hear that, oh, interest rates go down. That means that people are going to be the prices of homes come down. Normally, that's not the case. Usually you lower interest rates, prices of assets go up. But we're living in fucking bizarro world right now. Bizarro world that so many people got into their 3 and 4% interest rates in the last 5 years, and they were able to refinance. There is a plethora of people looking to get out of their current housing into maybe other housing. Maybe they want to downsize. Maybe they want to upsize. Maybe they had a death in the family, but they're holding off on selling right now. And so the inventory is so low that right now, the actual buyers that are out there that are forming new households, they're not being able to get in at a decent price, and they're paying at the top. When interest rates come down, I think this is what's going to happen. Inventory is going to start coming onto the market. It's going to start competing. The price of inventory is going to come down. And all these people who bought homes at the top with 7-8% interest rates are not going to be able to refinance because there's no equity in the property to refinance. That's the problem.
One other thing that I want to mention is, like, you and I, Chris, we can't buy Bitcoin together, or we can't invest in the S&P 500. But real estate investing is something that you can do with a group of people. It helps you mitigate your risk, amplify your spending power. It also allows you to pull together brains, right? And so then at some point you can go and start branching up and doing things on your own. So if you are young and you're in your 20s, you might not have the capital or the knowledge to do it. But if you pair up with somebody, it mitigates some of that risk, and that could actually make it fun. So,
but I'm wondering,
I think it's something to consider for the younger generation, where they don't consider it all that much, because here's what happens anyway. And like, at least in Manhattan, like Manhattan now is a really great place to live if you're in your 20s. But a lot of these kids, a PA at some television network, they're making $50,000 a year. How do they live in the city? Why? Because there's 7 of them in an apartment. So there's 6 or 7 of them all living together, right? So it's the same sort of deal. Pull your money together and work and have it work for you, especially at that young age. I know a lot of kids that did that, and now in their 30s, they're sitting on massive amounts of equity in their buildings, and they're either able to buy another property and hold on to the first one, or sell out of the first one and put a massive down payment on the second one, which is in Park Slope, and an $800,000-$900,000 apartment, they're paying a $200,000 mortgage, so they're chilling. That's how a lot of those people
the thing
do.
is, you have to go into real estate knowing that it's a 10-year thing. And a lot of people once again, Chris, you're talking about speculators. If you don't go into understanding that you have to keep this thing for a decade, that's where.
But he is talking about speculators, though. He's talking about.
That's what I'm saying. But I'm not talking about speculators.
That's not speculating. This is not.
I know, but then you guys aren't. But then there's no conversation here. You guys are talking.
There is
two different topics.
See, the problem is I'm actually in the market looking at properties for real. Okay, at the 2-family level to the 4-family level. I'm not dealing with big buildings, so maybe Chris is looking only at big buildings, commercial buildings. Those properties are going like hotcakes by investors paying cash who don't care about the price, who don't care about the rates. So my point is, when rates come down, the same people are just going to have it easier to get that stuff, not harder. Okay, it's not going to be harder for them to buy those properties, especially if I'm still looking and I'm not as big as those guys.
Just put it into perspective that the only person that's running this channel is Amit. No one else can put those comments up. So it's just Amit commenting in the chat,
putting comments,
and then putting comments in the
He's putting up his own.
There could be something around single family homes that's something that's to be concerned about. Single family homes in more rural areas during COVID were bought up like crazy. So
I got offers, bro, every day. I saw the flyers in the mail telling me to sell. I get emails every day from Zillow. Want to know the value of your home? Go up. Even from my broker, the broker, the guy that got me the loan. I'm getting emails from them asking me to sell. I told you I had my house appraised recently just to see what the value would be. And the reason I didn't sell is because the rates are too high. Now, if the rates do go down to 2%, I think in the same way that it was beneficial to the people that made the move immediately when we had the COVID lockdowns, those first movers are gonna skill it. They're gonna move out. They're gonna move out of their place. They're gonna get paid at the top of the market, and then
you better go quick.
The next one. You gotta go quick. Yeah, you got to go real quick. But then after that, like you said, it becomes diminishing returns, because about a year later, I know someone that was the exact opposite. They were the 11th offer on a house. 9 of them were like all cash. A bunch of them fell through. They ended up getting the home and had to pay $250,000 over asking. So a $500,000 property, which was smaller than my house, like a 1,200 square foot house, $750,000. They have to stay in that house for 10 years, like minimum, before they can start to see any return on that investment.
So
Go
ahead,
Go
okay, because I just want to make sure that because we have already passed an hour.
Yeah, we'll wrap
I'm
it up.
supposed to be keeping us on some sort of schedule here. We're already past the time, so I'm sure we'll go 10 minutes later. However, I need to jump off now. The title of the thing is Too Many Jobs. Okay, so let me just preface this, and then I'll let you guys fight about it. But
and he's like, I'm out.
Have you ever
There
watched
was
an episode
200
of Finance Junkies?
I know, but
we don't
this
care
is what
about the
Amit
title.
does.
In fact,
he's
you
got-
just told me the title. I didn't even look up there and know what the
The title is Tanner to Zero.
Okay, let me know if you guys have any opinions on this. There was an expected amount of jobs, new jobs in June of 225,000 new jobs. What we actually saw was 497,000 new jobs, mainly from small companies, not large businesses, in consumer-facing services, leisure and hospitality, transportation, and health services. What does this mean for the market?
What I would
Also
love to know-
the market is
construction.
now.
I'm gonna leave with you, Tanner. But yes,
What I would love
this is
to know. What I would love to know is how many of those people have taken more than one job. This is something that I don't think there's any data on that. How many of those are someone taking on 2 jobs in order to make the ends meet? So it might be a bit deceiving to think that 400,000 people went back to work that didn't. But people are struggling and working a day job, driving Uber at night or whatever. And I know some of these people that have had to do these things. So that's something that I would love to know.
I'd like to know how did they get the statistics? Is it actually by Social Security? But then that
It's
that
ADP
happens.
data. It's ADP
Yeah,
data.
this is
It's
ADP
from the company.
research.
So ADP does all the payroll for a lot of companies. So that's how they got the data. They were able to factor that. So this is accurate data. So just to preface it, the one thing that I wanted to say, a lot of these jobs that were created, I don't know
I gotta go, though.
a lot of them were.
You guys can hash it out.
All right, then you don't get a quarter of that 1999.
We
Sorry.
don't get anything. Amit's been collecting all of them.
Yeah,
We
I
don't
was
get
here.
anything.
I was here a long time. I deserve 15 cents. All right, later. Bye.
So I think a lot of this was, first of all, leisure and travel was a big component of the additions, and also not manufacturing, construction. So with leisure and travel, what we're seeing is seasonality take impact, right? It's the summertime. Everyone wants to travel. I was in the airport a few weeks ago, prior to July 4th. The goddamn place was packed, right? Everyone and their mother is like, finally, lockdowns are completely over. They don't have to wear masks anymore. People are just going ham out there, spending money. So yes, there's a huge demand pickup for leisure. Like cruise ships are packed right now. You try to get a reservation on a cruise ship, good luck.
Yeah.
Well,
a lot of those tickets were bought during the pandemic. They would sell those tickets a year out.
Yeah. So a lot of
for 2 more years. Yeah.
Yep. A lot of this leisure like travel that we're seeing, these are not permanent jobs. A lot of it is seasonality. And if a recession does come, these jobs are usually the first ones to get cut. So just to be on the transparent side, it's kind of worrying. The other thing is construction, because right now home builders are just going crazy.
Right.
They see the low inventory out there in terms of housing. So what are they doing? They are building as much housing as you possibly can build. The amount of single family homes and multifamily homes under construction right now it's
like an all-time high, right?
Since 1986. It's the highest level of multifamily construction since 1986. 1.4 million multifamily units are to be delivered within the next 1.5 to 2 years, right? These units are going to be competing with existing inventory because everyone's like, oh, there's no inventory. Yeah. This is what's going to happen. I think we are in a serious, weird situation where housing will underperform for the next 5 to 10 years.
5 years, yeah.
This is not me saying, oh, you shouldn't buy a home. This is just me saying, look, in terms of total return, you're probably better off in another asset class as opposed to real estate, or at least multifamily and single family real estate, where there seems to be a lot of competition that's going to be coming around. So, I mean, unless our population, yeah.
But that said, owning a home is the foundation of true wealth because of how much of the percentage of your overall bills it is. So if you can get into a home and you're looking to stay there for the next 5 to 10 years, that is something where I do agree with Vitaly. The rate almost doesn't matter because there's nothing that's going to outweigh the advantages that you're saving by not paying someone else's mortgage, and then do all of the other things that you're saying. I agree with, but I just can't imagine that, say, the last 5 or 6 years having paid all of that money. It's in the hundreds of thousands, man. That I
agree.
To somebody else. So
I'm not disagreeing with you. The only thing is when people buy homes, they think, oh, well, you know what? I'm buying a home, blah, blah. Dude, you're renting the money. You're renting the money from a bank. So if you're paying $800,000, for a house that's actually worth 400,000 or 500,000, because the reason why, the market is over, you're literally renting money. That's the thing. The interest charges that you have, you're going to have to pay. On top of it, you're going to have to pay property taxes, which are also going up. Home insurance taxes that are going up.
Well, that higher price commands a higher property tax, which is
right.
Yeah, which is
right. Right. And then on top of it, you have all the replacement costs that go in with housing and everything else. Once again, if you are living in the home and this is an expense that you are going to mandatorily have, by all means, buying a home is not a bad idea. If you are trying to compete against multifamily housing, plus all the single family housing that's being constructed and being rented right now, I think you're in a world of hurt because your cash flow is not going to support the amount of money you need to profitably run that home. So I know a lot of Wall Street landlords that had bought in 2008 and 9 and 10. What happened was, after the great financial crisis, companies like Blackstone came in and bought swaths of homes, like single family homes, right? Because there's so many foreclosures. You remember that? There are foreclosures goddamn everywhere. These guys, they bought them all up at cheap prices, okay? They bought them up with cheap prices, with cheap capital that they were able to get because the price of interest had gone down. They bought them up, refurbed them, rented them out, making great returns for their shareholders. Like if you look at one of those companies, Invitation Homes, they bought up a whole bunch. They used to be part of Blackstone. Blackstone rolled them off as an IPO, and then they're on their own right now. What you're starting to see right now among the Wall Street single family speculators, they're actually net selling the homes off. Which is like the canary in the coal mine for me, Carlos. I'm looking at them and they're selling off properties right now.
Right.
Because they know this is the top of the market. The amount of money that's going to
exactly.
The money that they're going to be able,
the floor comes out of it.
Right. The money that they're going to be able to collect for the rent is not enough to justify the amount of money that they have. The other thing is, all of these homes were financed via debt. Right. So the debt now is much higher. So if they have to refinance in the middle of all of this using corporate debt, they're going to go from paying 1%, 2%, 3%, 4% in corporate debt to now paying 8%, 9%, 10%, and basically destroy their own margins and end up going bankrupt. Right. So they are unloading and delevering as fast as they can. And I think we're going to see something come around with this.
I don't disagree with you. I don't disagree with you. I don't know how or where it's coming, but I do see some sort of macro event just triggering, a rug pull type event. I don't even know. I don't know exactly where or when. I thought that we would be seeing the signs of it now. And the thing is, maybe we are. Maybe when we look back, when it does happen, we'll be able to, go back in time and see that the signs were there. Yeah. But that's one of the reasons why, I heard you guys talking in the beginning, like, what are you buying? And so that's one of the reasons why I'm trying to keep as big of a cash position as I am now. This is probably one of the biggest cash positions that I've kept on the sidelines just because for that reason. And I'm taking a calculated bet because the market could get away from me. Right. But I feel good about the investments that I've had, that I've been able to make in the stocks that I've made, but I'm still very, very, I'm cautiously optimistic or cautiously skeptical. Where, what is it? The market rating is like extreme greed right now. It doesn't stay like that for long.
Yeah. I think we're
closer. I just got here.
there's definitely gonna be some mean reversion, man. So I'm like I said, I'm skeptical, but I'm not like this is where you have to be very nuanced in the way you approach it. Like there are going to be some cities that are going to be do very well. They're going to do well. Like New York City, still growing. People are still moving there. But maybe some parts of Florida are not going to do as well. Maybe some parts of Texas, like Austin right now, Austin is down 15% year over year for their housing or for their rent. I have to double check. But Austin is starting to correct.
They had such an influx, like Florida and Texas had such an influx over the last couple of years. It has to stabilize at some point. Yeah, because a lot of California money was coming to those states, right?
Yeah. The other thing too is like a lot of cities that had predominantly been bought up by investors to do Airbnb. There's legislation that's coming around because of the unaffordability crisis where localities are restricting Airbnbs. And I think that is a good thing for the end user,
I think so,
long-term renter. But at the same time, it's really bad for those people who bought in the last 5 years thinking that they had an endless stream of income coming in from their Airbnbs. And when they did their financing,
I forgot this was part of the this was a tangent thread that happened off of that Uber conversation that happened was on Twitter a couple of I don't know, about a week ago, that we were talking about the amount of fees that they've been charging. Airbnb has been getting crazy with the fees in terms of trying to stay profitable, and it's just not as appealing as it once was. It doesn't have that cool factor to me. Neither does VRBO. I've used both of those services a lot less, and I'm sure I'm not alone, right? So I think that in itself was kind of like a bubble. It was the first movers or the people that already had the places, sure, but now I'm not so sure.
See, this is where I really want to just show this screen, but you know what? Maybe Amit is in there. He can click on show.
Or we should, or listen. Yeah, we should call it. There was one thing when you guys were talking. Okay, yeah. I feel like I've met.
There you
go. All right.
So this is like the declines of.
Bring it up.
Yeah, can you see it? Yeah.
Scale it up.
There you go. Can you see that?
Yeah, a little better. Yeah,
so depending on locations right now, you're starting to see year over year decline. Not a lot. It's not like, oh my God, like we're going back to 2019 levels just yet, but you can see the start of decreases and a trend of prices. So here it is, like Las Vegas area has taken a year over year, a 6% drop. Riverside, Bernardino, maybe in California.
That's actually substantial.
Yeah.
6% is pretty high.
Right. In terms of rent, this is not the price of the home. This is rent, right? So the thing is, though, rents precede, I think, prices of the home itself.
Exactly.
Because like if you can't rent your property for more than the cash flow, you got a problem here. On the other end, you also have alternative, like where can you generate positive return?
Where can you put the money? Right.
Right. So like right now you're starting to see, like, I mean, and some of this is goddamn necessary. Like people went from literally $1,340 to like $1,600, like $300 per year increase. And the median income hasn't gone up that much in that area, So you're starting to
so much of it, like you said, does depend on the state. Like I think you have to look at the big markets, right? New York City, California, or say certain parts of Texas, the high density, the high population density centers. That's where you really got to look at it, because in the rural areas you don't really get much inflow and outflow.
Yeah. I think also like Airbnb is another thing that like some people are saying
about that IPO, and I'm glad I didn't buy that.
Yeah. Well, the thing is with Airbnb, I think they have a long road ahead of them where they're going to be profitable. Like they're going to be making money, because at the end of the day, they're a transactional business. All they're really doing is just listing. They're getting a commission from being able to list, and the total addressable market.
They're a matchmaker. That's a great one. That's a great.
Their total addressable market is the goddamn world.
Is the planet.
Sure. Let's say tomorrow morning, California, like a city says, oh, you know what? We don't want short-term rentals. Big fucking deal. They have the entire planet. Like you go anywhere, there's Airbnbs right now, but there's a lot of places that are banning Airbnbs because of like the affordability crisis that's starting to pop up.
Which is true, because it does get a bit predatory. Or what you do is you make it percentages, so everybody can have a piece of the pie. But at the end of the day, I do think that you should not, one generation should not make it harder for the next generation to buy homes. It's just such a vital, important part. We've already made it so that you can't really buy a property anymore on like a single person's income. You really do need that double income. So I feel like at some point it's robbing the future generation of true wealth generation.
I was telling my wife, I said, I blame you because my wife is like, you know, she's more of a liberal side. She's like, you know, so I was telling her today, I was like, all you had to do was just stay in the kitchen and bake some casseroles and your entire generation would have just been chilling at home like Susie Homemaker, right? It could have been single income households and that could have been the norm, but you wanted to be part of the corporate.
Right, you want to be a boss bitch.
Yeah, you want to go out there and be like, nah, I want to work. I want a boss. You know, all right, go out there. Now we're all forced to have two incomes. You know,
right.
Otherwise you can't survive. So women, you know, I know you want to just sit around and chill, but y'all screwed up.
My mom had it. My mom had it pretty easy.
Someone's like, Chris is the devil. Now,
Before,
Carlos, go ahead.
No, I was just gonna say before we go, there is a stock that I've been looking at because, like I was telling you, I feel like I've met a version of you at different points in my life. My friend Phil, who you met, which I think you guys would be like great friends. But there's another buddy of mine recently. He's a guy that I actually worked with a few years back, and he's been just hammering me on this one stock. And I've been looking at it, and I'm like, Anyway, it's something that I think we could probably talk about offline. We did talk about it, I think, Mercado Libre.
Mercado Libre, yeah, South America, the Amazon of South America.
Yeah, it reminded me when you guys were talking about so I started doing a little bit of DD on these guys, and I'm like, dude, triple digit. Check this out. Triple digit growth over 4 consecutive quarters since the beginning of the pandemic. Okay. Their stock is down now 50% over the year. And really the only potential downside that people see is just, what is it they say? The real downside would be just decline in activity. But the biggest markets are Mexico and Brazil. 5 countries started 2020 with the same e-commerce penetration rates that the 5 highest development countries had in 2014. 300 million digital buyers. The other thing that separates them is that they also offer digital payment services like PayPal. So anyway, at a certain point, I might have to start. It's only because the stock price is ridiculous. Have you seen it? They're like $1,600 a share.
$1,100.
It's ridiculous.
Dude, pre-COVID, that shit was like. I remember this was like one of my friends called me about this. Like this guy, he's a doctor, right? He actually did really well during the pandemic. He calls me up and he says, Chris, like I don't subscribe to the Motley Fool, but this guy looks like a hardcore believer in the Motley Fool. He's like, look, man, you need to buy this stock. You need to buy Fastly. You need to buy Mercado Libre. And this guy would I was like, man, this guy's a fucking idiot. Like how that he's coming to me telling me like I've been investing for the last goddamn 10 years. Like he doesn't know shit. This guy was following all the Motley Fool picks, and dude, he made off. I mean, he's already a doctor, so he's got a shit ton of cash. But he's like I think he's almost got like $10 million now in his portfolio. He sold at the top. He's like, yeah, you know, I'm telling you, man, Motley Fool, they killed it. But then Motley Fool got a little too greedy, and anyone who didn't sell out and they just held, or now they're in a bad place.
Overhauled. Anyway, that is something that I am looking at now, because especially this guy won't stop hammering me about it. And so when someone that you trust continually hammers you about something, I'm reminded of some of the previous times that I've listened to that and made a ton of money. So
anyway,
Mercado
Libre is only $50 billion. If you think about the total addressable market of South America, dude, it's a growing economy. If that's the primary mode of
dude, they're down 50%. They're down 50%. This is a $2,200 stock. Yeah. Oh man, Tanner loves that. I didn't know that. Oh shit. So maybe the next time we talk tomorrow.
Next time they were down 7% today. I'm looking at that $3.3 billion in, is it dollars or is it like in reals? No, I'm looking at their financials right now. $3 billion right now. It's up 35% year over year. Net income, their net income positive, which is good. Net income is growing fucking 300% year over year.
300% for last 4 quarters.
Yeah, it's
the other thing is
I gotta look at this.
Look at the when you look at Latin America, just the size of it, it's just so massive. It's so unbelievably massive. If you have a company that can address the needs of people in all of those regions, Anyway, I'm not a fan of the stock price, but I do feel like maybe, you know, you get into this position and they can do
their free cash flow is growing, their EBIT margin is growing, free cash flow per share is fucking up there.
You get into and just look at that run up, man. But you get into stock like this. I mean, this would be such a great candidate if it's split, because things like options are not really available on something like this, right? When the stock price is so high, if this thing does a 10 to 1 split and gets that stock price down around $100, woo.
I mean, that's fine. I try not, like, that's the mistake that so many people make. They look at the share price and judge based on that, but
But
is just.
But it's about options. It's just about an options play. You could argue that one of the reasons Apple got to where it got is because for the last 10, 15 years, the stock price, they've been splitting enough to keep the stock price in a comfortable range, both for retail investors and for the options market. So
yeah, they should. I mean, with fractional shares, I don't think it matters anymore. But then again, it does provide some comfort to people, I suppose.
Yeah. Anyway, I got a jet too. Kid duty.
All right, man. Talk to you guys later. Have a good one. Thanks for everyone.
Today's Thursday. Yeah, so that's the end of the week. We will see you on Sunday on the new channel. If you haven't, please hit like, subscribe, and find us on the Finance Junkie. There we go, the official Finance Junkies YouTube channel, and we'll see you on Sunday. Any parting words?
Yep. No, just be wary of the current market. Just keep your head on a swivel. There's opportunities that are coming, and there's areas where if you have to trim, you have to trim. Right.
There you go.
So,
All right, guys.
Later, guys.
Bye.